Consider a couple other things. First, 10 cents on the dollar for land, if that's your perspective and you have the right investors, that's dynamite. But you also have, you have 50 cents on the dollar for some office buildings. So it's an alternative investment issue. The other thing is just what you brought up, which is this is a very strange market where the fundamentals so far are intact. We're not, at least in the office building sector, we're not overbuilt like we were before. It is withdrawal of cheap debt which has fueled a decline in prices while it's still a healthy market. And if the recession has a soft landing, it will still be a healthy market. What we got is we've got capital withdrawal causing price reduction. And you can still buy healthy buildings in fundamentally healthy markets. At least today you can, at declined prices, because if you've got cash and you don't have to go for 60, 70, 80% leverage, if you can deal with 55% leverage, you can get that and you can execute a deal and you can take properties at very good prices. But if you have to be a strongly levered buyer, you're at a disadvantage. And those guys are sitting on the sidelines, so prices have dropped. And one of the innovations is some sellers who are strong have to give purchase money mortgages, try to get those prices back up. That's the new world we're going to be in, which we haven't seen for 20 years. But, it's just kind of a time warp now. But I think it's that fundamental that makes this a different market than we had back in the 1990s, late 80s.
Yeah, I think from our perspective, there's one thing that you can point to that kind of tells you how this market is working. There's one sector that has cheap access to capital for financing, and that's the multifamily sector, and that's through Freddie and Fannie, excuse me. It's interesting to watch. There is significant deal flow. There are deals getting done. There's leverage to be had anywhere from the 65 to 75% range, depending on how you're doing it. You got to walk through the process with Freddie and Fannie, but you can get deals done, and you can get a lot of deals done. In fact, one of the big REITs that was out there was Post. The only reason that REIT was out there was financing available from Freddie and Fannie to do that. And so if you look at that sector and you actually track assets, good assets in almost across the country, cap rates have moved, some people say 15 basis points. If you're smart enough to tell me that cap rates have moved 15 basis points, then you're better at this than I am. So what it basically says is the fundamentals are still strong. Obviously, multifamily is looked at as a recessionary or a hedge to a recessionary economy, so it has some strong fundamentals going into it. But if you look at what the fundamentals are telling you in most of the markets, and again, it's early in a cycle, so we could be still 6 months behind what might happen in a soft landing. If the debt markets were there, even at a 65 or 70% bid, the problem is there's lots of ask and no bid. There's not a bank in the world right now that will lend you more than $100 million on any asset. So the world of big deals is gone. Unless you can cobble together 3 or 4 lenders to try to put together a financing package, which is not easy in this environment. So that's really what will drive a resurgence of a normalized buying and selling market when the lenders can get to that level. There's a lot of reasons why they haven't gotten back. One of them is they haven't cleared the bad stuff off. That's starting to happen. They also needed a kind of a change in the momentum of the world, so to speak, in terms of who was running the company. And so that has happened as well. So you will see over the next 6 to 8 months that happen. Our greatest fear is that the banks don't come back. And what I mean by that is CMBS lenders accounted for about 60 to 70% of all the lending that was done in the last 2 years. That's zero right now. There is no CMBS debt out there. A lot of groups you've heard tangentially, none of the big banks, but a lot of other groups have shut down their CMBS arms. They're not going to do it. Made a lot of money on the way up, and then they lost it all on the way down, and kind of wondering if it's a good business. We sit there and we worry what happens if they don't come back, or if they do, they come back very small, and it may take 3 or 4 years for them to get back. And so until you have a market economy where you can realistically think you're going to be able to get debt at some level, whatever that level may be, it's going to be very difficult for this market to rebound. One of the things that Walton Street, because we can do a lot of different things, is doing, and I should have mentioned, is we are starting a origination platform where we're going to, really as a private equity play, go out and create a financing vehicle and give loans in this environment, because we think it's a very opportunistic way to make money and build that business over time. We'd seed it with a lot of money from the fund, go out and raise money around it, and then look at selling that vehicle in the future or taking it public when markets kind of stabilize. We're having a really good book of loans. So it's one thing that we're looking at and try to kind of feed into that negative thought is, there will be people who will fill that void, hopefully, over time.
Harry, just a